All right. Hello, everyone, and welcome back to our Retirement Basics video series. My name is Greg Parker, and I'm the managing partner with Engraved Wealth Partners. If you've watched the first few videos, you've heard a consistent theme. Our goal is to limit the reach of the IRS into your retirement savings. As part of that strategy, we first had to identify where is the tax problem coming from when it comes to retirement. And you probably recognize this slide that we used to describe where the tax problem comes from. You see, in retirement, the majority of your retirement savings tends to show up in the red bucket, which is the IRA rollover. Simply put, that is the culmination of your pension lump sum distribution, should you choose to go that route, as well as the rollover from your 401k savings plan. It's not a bad thing to have that big of a bucket for retirement savings, but there is a little bit of a problem with that bucket. You see, traditional financial planning, you will hear advisors say things like, well, we're not going to incur a lot of taxes in these early years. We want to push that off as long as we can. And so we're going to try to find income sources for you that do not have as much tax implication. Well, what does that really mean? What that means is they want you to live off of the blue bucket or the green bucket, the brokerage account or the Roth IRA, for as long as you can, so that they don't have to pay taxes on any retirement distributions. Again, not at all a bad strategy in the big picture. However, it is neglecting a significant tax issue that you're going to be facing at age 72. And we tried to describe what that looks like when we showed this chart. This is a simple graph showing the increasing demands of your retirement income. I used an example here of someone who gets $150,000 a year with a very modest 2.5% per year increase to account for inflation. Using this graph, what I also tried to show is what would your taxes look like during those years of taking retirement distributions. Again, in the early years, I showed in the green line that your tax liabilities are probably going to be somewhat minimal, especially compared to your last few years working. However, there's a very noticeable uptick on our graph using this hypothetical retiree starting in year 2031. If you're looking at this graph, you might be asking, well, what in the world would that come from? Folks, that increase in the taxes paid graph comes from the age 72 RMDs, required minimum distributions. Essentially, what that rule says, as you recall, is that the IRS requires you to begin distributing proceeds out of your retirement savings, namely your 401k, your IRA, or any other qualified retirement savings you may have, and pay taxes on those distributions. Those taxes will be recognized as ordinary income, which is the same type of income as salary or wages, meaning that that income gets applied to the marginal bracket system. Folks, RMDs are an extremely expensive form of income to take when it comes to retirement. The problem is at age 72, you don't get a choice. The IRS says you must begin taking them. So what we decided to do was focus instead on how can we help minimize the tax liability you may face when it comes to retirement. One of the strategies that we want to share with you is a tax strategy known as NUA. You might have heard of NUA before, talking at the water cooler or some of the different groups that are around at work, but NUA is a simple tax strategy, and it's an acronym that stands for Net Unrealized Appreciation. Net Unrealized Appreciation is only applicable to you if you have company stock inside your 401k. If you've worked at a company that is publicly traded and they've allowed you to buy the stock inside the 401k, I can promise you that NUA could be a tremendous tax advantage for you. Now, here's the problem with NUA. There's some nuances to it you need to know about. And for that reason, most financial advisors and even many tax planners don't like to get too involved with the NUA decisions. We look at it a different way. I'm going to bring alongside some of our CPA partners, as well as our certified financial planners, and let them build out a custom NUA strategy that is designed to save you the most in taxes we can, so that you can recognize fewer taxes paid later on down the road. So how does NUA really work? Well, looking at NUA, before you retire, you've got money in a 401k savings plan that generally would consist of your company stock plus non-stock investments. So that could be mutual funds, that could be index funds, could be other bonds and so forth in the portfolio. But the 401k, as we're looking at here today, that really matters is where you have company stock. You see, all of you know that at retirement, you can roll the 401k directly into an IRA rollover. That avoids any tax liability that you would have to pay in the year of retirement. However, what we've already shown is by sending all of those proceeds to the IRA, you're simply building up a bigger and bigger tax liability at age 72. What if there was something we could do before you move the money to the IRA that would allow for some potential tax savings? Well, that's what NUA does. NUA allows you, before you move the 401k, to take the company stock out of the savings plan and move it into an after-tax individual or joint brokerage account. Now, what benefit is that? Well, there are some tremendous opportunities for tax savings if we do that. Namely, net unrealized appreciation allows you to move any amount of your company stock from your 401k savings plan into the after-tax brokerage account and only pay taxes on the original cost basis of the stock. What that means is you only have to pay tax on the original price paid for the stock. You do not pay any taxes on today's market value. That's where the tax savings comes in. If your company stock was purchased at a lower price than today's market value, it is highly probable that you have a tax benefit from NUA. All you've got to do is go back to your 401k statement, look at the average cost per share that you paid, or some companies break down every share you bought and they show you the actual cost basis. Folks, we can help you look at that and determine whether or not NUA makes sense to you. Let me walk through an example of this so that you can know exactly what I'm talking about. When I think about NUA, I've got a hypothetical example of someone who has worked at the company for a number of years. He or she has been buying the company stock faithfully. They started buying the stock many years ago when the stock price was much lower. In my example, I'm using 20,000 shares of stock at an average cost of $20 per share, which means the total cost over the career of buying that stock was $400,000. In the example, today's stock price is $100 per share, meaning that the stock is now worth $2 million. Now, again, it's a rather extreme example, but I want to use it because the numbers make it easy to see where the tax savings can come from. So what do you do if you're about to retire? You want to look at NUA as an option and decide how many shares of your company stock should you use for NUA? Well, let's start with a very basic scenario. At the very basic level, I'm going to recommend that you take at least 2,500 shares of your company stock as NUA. Again, we're going to move that stock from the original 401k into your after-tax joint or individual brokerage account. Now, by doing so, we are going to recognize 2,500 shares and their cost basis. Again, if our average cost basis is $20 a share, the 2,500 shares has a total cost basis of $50,000. $50,000 as a cost basis would then be reportable as ordinary income on our tax return. It would be added to any other ordinary income, such as salary or wages that we got for the year, and we would pay taxes based on the marginal brackets. But there is one catch with NUA that you need to know about. I overlooked the fact that this individual had been setting money aside over and above the pre-approved IRS limits for 401k pre-tax contributions. Now, I know that's confusing. What it's basically saying is the IRS lets you put money in the 401k before taxes, but you've contributed over and above that amount. And so you have what is known as an after-tax contribution bucket. Folks, if you're not sure if you've got that, usually it's down there on page 2 or 3 of your 401k statement, and it'll generally say something like post-1986 after-tax contributions. Extremely important information. If you've been setting money aside in that bucket, you've got money that has already been taxed, and the IRS allows some very special privileges for that type of money. In our example, your after-tax contributions can effectively be swapped with your NUA shares for tax purposes. Doesn't mean you're going to lose any of the shares. What it simply says is you can reduce your cost basis of NUA shares dollar for dollar by using your after-tax contributions. So in this case, the $50,000 of cost basis is reduced to zero because we used $50,000 of after-tax contributions. Well, what if I don't have $50,000 of after-tax contributions? What if I only have $25,000? Well, that's going to help dictate how many shares we recommend taking. In this particular case, the $50,000 of after-tax contributions is why we chose 2,500 shares, because what it means is you're able to use NUA for absolutely no tax liability. You heard that right, folks. You can move 2,500 shares of company stock out of your 401k at the time of retirement into your individual or joint brokerage account tax-free. There's no taxes due because your after-tax contributions reduced your cost basis to zero. Folks, those 2,500 shares have a market value at $100 per share of $250,000. That's a $250,000 tax-free distribution at the time of retirement. You understand now why NUA is so powerful. Now, honestly, that's not what I'm going to recommend for this individual. Again, this is somebody that we've actually worked with. And what we did for them was we recommended an additional 6,250 shares coming out of the 401k of their company stock, going into an after-tax brokerage account. Now, at first glance, you're looking at that going, well, why on earth would I want to do that? Now I've got to pay taxes. That's true, but hear me out. The 6,250 shares at $20 per share has a cost basis of $125,000 total. I'm still going to use your after-tax contributions to reduce that cost basis. 125,000 minus 50,000 leaves us with ordinary taxable income to report of $75,000. Again, that's going to be added to any other taxable income you've received that year, salary, wages, whatever, and you will pay taxes based on your marginal bracket. Or if the individual we were talking about here, they retired at the beginning of a calendar year, they didn't have a lot of salary recognized yet, and so we were able to take the extra shares of NUA out, and it only cost them $8,605 in taxes. Why? Because the cost basis that was left over plus their other income meant that they stayed in a very low marginal bracket that year. The $8,605 would simply be reportable as taxable income or taxes due when they file their return. But look at the difference. They now have 6,250 shares at $100 a share, meaning $625,000 of stock just came out of the 401k, and it only cost them $8,600 to do it. Folks, there's no other opportunity to save money on taxes like that when it comes to doing retirement math. This is a solution that is going to be highly customized depending upon the individual situation. There is no one size fits all. It's going to depend upon how much other income you've recognized, how many shares of stock you've got, how much your original cost basis was, what today's market value is, and how much after-tax contribution money you've got. This is why we encourage you to build the personalized retirement analysis that we do that helps you see exactly how this can help put tax savings into your pocket. Remember the overall plan. When we send money to the IRA is going to continue to grow and will be taxable at age 72. We're using NUA in this case to circumvent the IRA and go directly into the blue bucket, that after-tax brokerage account. Folks, there are tremendous benefits to using NUA. Please do not let any financial advisor or any CPA tell you that NUA is too confusing. Come talk to the experts. Let us run the numbers and help you see what the benefit of NUA can be. Let me share with you a couple of extremely common questions that we get when it comes to NUA as we close. Number one question I always get is, do I have to sell my company stock in order to use NUA? The answer is no, you do not. The whole purpose of NUA is to continue to own the shares indefinitely by moving them out of the 401k and into the brokerage account. In fact, one of the greatest tax benefits is that those shares, once they move out of the 401k into the after-tax brokerage account, if they ever are sold, now are recognized as long-term capital gains which under today's current tax structure enjoys far more favorable tax rates. Long-term capital gain rates generally max out at 15% for most taxpayers, unless you're in the absolute highest marginal bracket, in which case long-term capital gains max out at 20%. In general, you do not need to sell the stock. You can continue to own it indefinitely, passing it down to future generations. But if you do need to sell it, it is still a major tax benefit. How much tax or what kind of tax would I owe if I use NUA? Well, the net cost basis, remember the cost basis of shares minus any after-tax contributions, is considered ordinary income in the year that you exercise NUA. That ordinary income, again, is the same as salary and wages, and the marginal brackets would apply to however much income you recognize. Another question I get, if NUA is such a great tax benefit, why would I not NUA all of my company stock? Well, simply put, because it would very likely recognize way too much ordinary income in the year of retirement. If you exercise all of your shares, you're going to have to pay taxes on the entire cost basis. In many cases, for those of you that have been at the company for a number of years, or those of you who have a lot of company stock in your plan, you could be forced to recognize an extraordinary amount of income that year that would push you into a 32, a 35, even a 37% marginal bracket, in which case that's too much in taxes to pay all at one time. Let us run the numbers so that you can see where the optimal point is for you to take as much as we can out of the 401k in the form of company stock without paying too much in taxes in 1 year. Finally, do I have to use NUA when I retire? Can I wait until a later time? You absolutely can, but the IRS rules dictate that net unrealized appreciation must be exercised within the calendar year of your first 401k distribution. So let's assume that you retire, maybe it's the second half of the year, you leave the 401k at the company, you don't touch it. But January of the following year, you need some income. So you go in and you take some income out of the 401k. Folks, that triggers an event that the IRS says, if you're going to use NUA, you must take that NUA before the end of the calendar year in which you take your first distribution. Why does that matter? Because if you miss that calendar year, NUA is gone forever. NUA is not something you can go back and retrofit or redo. It's a one-time option for exercise. It is eligible after you retire from the company before you take that first distribution. If you need help planning that out, please talk to our experts here so that we can help you see the benefits as to whether to take NUA in the year of retirement, perhaps the year after, or on some other schedule. Folks, I can't emphasize enough the importance of building out a personalized retirement analysis where you can see the way that these numbers are going to affect you so that you can answer the basic questions. Can I afford to retire? How much income can I get based on what I've got? What about my Roth conversions and NUA strategy for tax savings? Folks, that's what retirement optimization is all about. And this is what we provide to clients. This is absolutely free of charge. There's no obligations or contracts to sign. You simply send us some basic information that allow us to build your analysis within 1 to 2 business days. We'll schedule a meeting with you via Zoom or in our office so that we can share with you the retirement analysis. You will know exactly what your options are so that you can make the best decision for your family. Folks, retirement taxation is a major problem these days. If you have not looked at how it affects your numbers, please jump online to engravewealth.com, click the Start Your Free Retirement Analysis button, give us some basic information, and we will be in touch with you about scheduling your free analysis. Folks, thanks for being here today. We appreciate the time and attention. Tune in for strategy number 5, retirement basics number 5. I'm going to share one more retirement tax saving strategy with you that you do not want to miss. Thanks again for being here. Have a great one.